Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Eapen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@eapen.info. My guest today is Mr. Frank Van Gansbeke, who is a professor of practice at Middlebury College. Frank has more than 30 years of global senior executive experience in corporate finance and capital markets. Frank contributes articles to Forbes, connecting dots in international markets, sustainable finance, and Fintech. Welcome, Frank.
They're very welcome, Jill. So first of all, thank you for hosting me at your distinguished podcast series.
Absolutely. Absolutely. I want to start with one of your articles entitled Climate Change versus Bank Loan and Debt Capital Allocation Methodology, in which you say, in a study commissioned by a UK newspaper, Richard Head at the Climate Accountability Institute in the US identified 20 fossil fuel companies that were responsible for 35% of all energy-related carbon dioxide and methane releases worldwide. And since the Paris Climate Accord was signed, financial institutions worldwide provided $1.3 trillion in bank loans to the fossil fuel industry. Yet only 3 firms in the S&P 500 produce renewable energy, representing less than 1% of the S&P 500 market cap. So you ask, is there a solution to this brutal and ecosystem-threatening cycle? Could things be done differently in 2020? You want to talk about that?
Sure, Jill. So, but in order to position the article, I would love to actually give a bit more background about my interest in terms of things that keep me busy and things that I try to understand. So, as you mentioned, I try to connect some of the dots. So. At the moment, I think my real interest, is focusing on gaining a better understanding how we ended up in this current predicament, from a historic economic and financial market perspective, right? So, and as importantly, it's also exploring at some of the pathways which may assist us in providing us with more sustainable economic and financial outcomes, including a better quality of life, right? So that's, and I would love to connect this, I think, to get this into broader perspective, to start it off, to consider the what some economists have mentioned, the Buddenbrook dynamics, and that's referencing to a 1901 Thomas Mann novel. So Thomas Mann was a German author who got the Nobel Prize for Literature, and in which he is describing the story and the decline of a very wealthy family, the Buddenbrooks. And it's narrated over 4 generations. So, and it's inspired by a true Hanseatic bourgeoisie family.
Yeah.
And so if we transpose that family novel over the period, so from the end of the Second World War to today, we match about 75 years concurring with, Thomas Mann's 4 generations. And so these 4 generations, actually, what does that mean? So I think you have, at the beginning, you have very, very hardworking grandparents. You have or great grandparents to start off with, and continued effort by those by the grandparents, And then you have slowly but surely, the parents starting to benefit from accumulated wealth, and then the last generation actually starting to fully consume that wealth. So I think that's, and again, I don't want to harp here on the current generation. I think on the contrary, I think it's just a development. It's a cycle that happens and that we've seen through history, reoccur. And so this is where we are today in 2020. I think this is an element. I think, as I said, this depiction of the cycle over 4 generations or life generations. Now, on top of that, we had the last 20 years, we have experienced 3 once-in-a-century kind of events. The 9/11 attack, the 2008 financial crisis, and now the COVID-19 pandemic. Right? So with the 9/11 attack, we have entered, 2 wars in Afghanistan and Iraq. Each had a price tag of about 4 trillion, and with a sustained fear and a war on terrorism, including a major NSA-led initiative to start tracing every citizen's communication. Secondly, in 2008 financial crisis, we experienced the largest financial bailout since the 1930s, with a Federal Reserve response and generating about the printing of money, and I come back to that later, so exercise, and still leaving about 3.5 trillion of assets on the Fed books, on the Federal Reserve's books, its balance sheet, prior to the onset of the COVID-19 crisis.
Right.
So this 2008 crisis disseminated jobs and wealth and installed an endured fear about the economic future of the current generation and its offspring. Right. This is still the place we're still, suffering from the consequences of that major calamity. And now we're faced with a global, the global public health crisis, the COVID-19 pandemic, and costing so far the Fed to intervene to the tune of at least 3 trillion, and we're still counting. I think there's more stimulus packages coming, finding its way. So, but again, by means of money printing to finance the much needed stimulus packages. So the current crisis has now entailed basic fear about life or death, and by extension, the future fate of life, not to mention the psychological trauma which might ensue the sustained periods of lockdown and the fact that we can't meet and that we still have to keep the 6 feet distancing approach. Now, out of these 3 major events, we have as a common denominator complacency. Right. So in 2001, it was the inability to act upon detailed garnered intelligence. In 2008, it was the outcome of several issues. So to name the most important ones, the fully deregulated financial sector, and I'll come back to that later on. The 2, accommodating central bank monetary policy. The fact that we have seen enormous monetary growth and leverage by banks, also fueling at your introduction reference, the fossil fuel companies, and then the absence of sufficient prudential oversight by regulatory authorities. And now, in 2020, we have the outcome of the gutting of basic public health provisions over the years, coupled with a overall loss of ability to effectively manage a nationwide crisis. So we are faced with our predicament. So that's, and just to give some statistics here, I mean, just some numbers to give it all where we are today, 2020, right? And to frame again this, I'm trying to frame this overall environment. We have a total debt in the US approximating about 27 trillion. So it's 27,000 billion. We have a budget deficit close to about 3 trillion for the first 10 months of the 2020 fiscal year. So there's a difference in calendar year and the fiscal year here. But so we have approximately 5.5 million COVID-19 infected people, 175,000 people who died in the process. But we also have 1.7 million people who suffered from substance abuse, right, and substance use disorders. 1.7 million. Right? So we have for 2020 alone about 1.8 million of new cancer cases and an estimated number of 600,000 plus deaths this year alone. 600,000 deaths as a result of cancer. We have, regarding climate change, we have 412 parts per million in carbon dioxide particles in the atmosphere. In 1950, so again, I'm coming back to this 4 generations. So at the beginning there, we reached, we had about a level of about 300 ppm. So we have more than a 33% increase in the carbon dioxide readings. And as a result of, and as recently as this week, we also are seeing the highest record temperatures in Death Valley, and more than 160,000 people, displaced as a result of 2 wildfires in California. So the impact is now indirect, and it's there in the face of us, right? Mm-hmm. So we have this crisis today. It's composed of about 6 different dimensions. So public health, financial, social injustice, the inequality, so the 1% against the 99%, the climate change crisis, and then, the one that we also have, the distrust in our institutions and the functionings thereof, and international trade.
Yeah, so, when I think about this, Frank, I think it paints a horrific picture, right? And you don't know where to start. But when I think about this, climate change is a foundational issue, right? Which, mm-hmm. if you don't intervene optimally, you don't really have a chance to intervene in the future, right? Things like cancer and COVID, are things that we can work on. It's going to take some time. And then the debt itself, correct me if this is just my perspective, is more of a financial issue. So when I think about these 3 items, debt, disease, and climate change, they're not really comparable things. Mm-hmm. Do you see it that way?
Yes, but they are interconnected. So I think, I would agree with you that climate change is absolutely, I think it's a existential threat to our ecosystem and our well-being and everything else that we can actually deploy from there on, right? So, but there is the whole thing is also that this climate change is also, it's an element of man-made intervention. And so now again, I'm coming back to my 4 generations, and I said about the reading of, we only had, as I said, in 250, this 300 ppm CO2 reading. Yeah. And today it's in excess of 410. So this is all as a result of some elements that have taken place that allowed this to happen. So this is, as a result, we have an excess release of greenhouse gas in the atmosphere, which is creating this increase in temperature, right? So I think, and this is where we are seeing these outcomes of climate change fatalities, as I referenced, in the California or in Death Valley, the highest temperature to date on record. So, but there is a connection to that, right? So, and again, I would concur with you that climate change is absolutely the overarching kind of element of concern, right? So to tackle that.
Yeah, I mean, the problem with climate change, as you know, is that you cannot see it. So policymakers with 4-year horizon, 4-year decision horizons, this is not in the top of their focus, right? It's something they can deal with 4 years later, at least from their perspective. And so we will keep pushing it in 4-year increments down the road. And at some point, we will reach a point that intervention is not really feasible.
Correct. I think, there is, of course, there is an element of denial or not, willingness to recognize, the challenge at hand, right? So there is, but it's also, again, where I come back, I think where we have some mechanisms embedded into our financial economy and into the financial markets. Yeah. So maybe let's, I think some elements that I want to focus on in that regard. So you mentioned on the fact that we only have 3 companies for renewable energy in the S&P 500 to date, right? So this is an outcome as it is. So again, given that crisis situation. So But I want us to come back again into perspective in the sense that we do have a lot of money has been created since we have the 1971 Bretton Woods kind of, the breakdown of our not the financial system, but the gold standard. And so up until between 45, as a result of the signing of the Bretton Woods Treaty and the 1971, the breakup of that agreement, we had before that a tie, between the amount of money that was outstanding and, a finite amount of gold. Now, with the tensions that arose, especially the budget tensions that arose as a result of financing of the Vietnam War, that link had to be broken up and had to be released. So,
yeah. So let's go into your paper. So, monetary authority and natural capital. What does the future hold? So you have some ideas there. So natural capital can be defined as the world stocks of natural assets, which include soil, air, water, and all living things. Mm-hmm. And you say economic and financial markets fail to adequately incorporate the depletion rate of our natural capital. Now, we can see that in a very, very clear way in fossil fuels, but there is a whole set of, decisions made where you're externalizing the cost related to the stock of assets the world holds to private profits, and this has been going on for a long time, right? So that is the issue that you're trying to analyze.
Correct. But the thing is, I think what needs to be understood. So what needs to be understood there, I think, and I'll make that connection. I need to have like one little connection or dot that I'd like to connect.
Yeah.
I think it's contrary to public belief. There is also a money creation function and ability that has been extended to commercial banks. So it's in public belief holds that money is being created by a central bank, and as a matter of fact, the central bank actually creates two types of money. So first of all, it's the physical coins and notes, and that's to the tune of about 2 trillion. And then the other one is in the case of bailout, as we've seen in 2008 and in COVID-19, that where we have a digital line of credit extended by the Treasury to the Fed that allows it to print money out of thin air, right? So there's this, and start buying, assets or inject stimulus money, as we have seen with the receipt of the cash checks of about 1,200, right? So as a result of the recent stimulus packages. So in between, you have commercial banks who have the ability by their extension of credit, the function of granting credits, that it can create money. And that's an ability. So it's not a central bank. It's the commercial banks that have that ability to create that money. And we have seen that since the 1971, there has been an increase, enormous increase in leverage. That was actually, a result of commercial banks extending credit to that and to the magnitude that we have seen. So now we have this enormous leverage, and we can see correlations with this amount of money that was created and the extension of credit to fossil fuel companies, as well as allowing for a extraction-led economy. Right? So we see this. We can actually there's a complete match as of the 1970s, and all the way up to 2020, where we are today. And so the argument I was making in my article is that we have, at the moment, a capital allocation, whether it's in the debt markets or in the equity markets, which is completely agnostic of the counterparty, its waste or its carbon footprint. Right. So if you do have two companies like Exxon or Unilever, at the moment, you take into account some counterparty risk, and you take into account some what we call idiosyncratic, so firm-specific kind of characteristics, and some overall market, dynamics into account to set the price of that credit or of the equity, the capital that's been allocated to those to any company that is wanting to raise money. And so we are making full abstraction of the cost of externalities. And
Yeah. So I have a question on that, Frank. So um, if I understand this correctly, that the Fed and the banks, the Fed is using the banks to lend money to the capital seeker.
mhm,
And to the extent that the capital seeker has no incentive to internalize public costs, can we really make a change there? You know, I mean, So I think what you're arguing is that you could actually take the Fed's policies and make it optimum for for society. But isn't Fed more of a sort of a tactical player in the sense that does the Fed have any view as to what societal welfare might be?
yes, I think it's a very good question. So there are multiple players in
Yeah.
this field, but there's also what we call an 80-20 rule, right? So I think, who are the people that have actually the clout to transact in the view of our, the calamity that we're facing today, or the different calamities, but, of which climate change is the most predominant one.
Yeah.
And so we can look at from the angle from the bank and from the institutional investor base, right? So, or the institutional asset and, the commercial bank. So I think if we look at these three type of sectors, so let's take, BlackRock. BlackRock currently is managing about 6.5 trillion of assets, or, has 6.5 trillion of assets under management.
Yeah.
So the CEO, Larry Fink, is every year he's making a statement about how profit and purpose should actually be connected by the companies in which they would like to invest.
Right.
And so in one of these engagement priorities, as it's mentioned, I think some of the element that it's specified is also the environmental risk concern that a company should embrace, right? So there is a link, or there is a very good intent, or there's a articulation of intent by a very large player, not to name it, BlackRock and CEO Larry Fink,
Yeah.
and the allocation of the 6.5 trillion. And so now, to the extent, but the question is, to what extent is that articulation of intent actually being crystallized into action,
Right.
and to tangible impact on the capital allocation and equity sphere, right? So to what extent does BlackRock say, right now, you have a carbon footprint of X, you are depleting our carbon reserve, of Y. So the whole question is, I think I will prioritize my capital allocation to a more nimble, in this case, it might be a renewable energy player, compared to, for example, a fossil fuel company. And so one of your outcomes is, as you have observed. So I think we only have 3 companies of the S&P 500 that are related into renewable energy.
Yeah.
And so we see changes right now. I think the overall S&P 500 now represents all the fossil fuel companies combined. Represent less than
Right.
Apple. So Apple, of course, now getting to 2 trillion. But that's the fact. That's one element. But at the other hand, I think where are the renewable energy companies? So when we're talking about capital allocation, why is it? What is holding us back? What are the impediments for us to allocate that capital from fossil fuel to renewable
Yeah.
energy?
So
Right?
yeah, let me ask you something on that, Frank. So the 6.5 trillion, using BlackRock as just as an example, that capital allocation decision by that intermediary is really going to reflect what capital providers want. So if shareholders are looking for tactical returns, the intermediary will allocate that capital according to the shareholders' wishes, right? And so aren't we back to a point that unless we have systemic change, meaning everybody in the market, capital seeker, capital provider, uh, want to internalize this cost that everybody knows exists, but has a perverse incentive not to internalize it. I don't know if the intermediary will have any impact on it.
Well, I think there's a
Yeah.
couple of things there. I think that I would like to observe. So I want to come back also on the central bank, but let's come first back on the fact that there is no willingness or no
Yeah.
apparent willingness to internalize these externalities of carbon footprint, right? So I think right now what we are seeing, we have enormous disclosure projects that are underway. So we have Carbon Disclosure Project, we have the TCFD. So this is an acronym, a very weird acronym, as a result of the G20, so the top 20 nations in the world, which have appointed Michael Bloomberg to start off this TCFD. And the TCFD stands for climate stress test related climate financial disclosures. So now every single listed company under the G20, all apply for each of the G20 nations, have to undertake several scenarios under which climate change are different tests or scenarios are being depicted, and they have to assess the impact on their balance sheet, on the supply chain, on their customers, and on the company themselves ultimately, right? So I think, and they have to start allocating or building sufficient solvency or capital to withstand those crisis occurrences. Now, that's an element. That's one. So the TCFD is one. So you have, I already mentioned, the Carbon Disclosure Project, and so there is this overarching initiative to push every single company to come forward with disclosures, right? So with what we have, so now you can actually build, or starting to build, a universe of best-in-class kind of performance in the overall universe of corporations. So this is the Unilevers, the Apples of this world, or the Exxon Mobils. So now you can see, now you can establish this universe and this distribution of best-in-class. What you could come up with is also, you say, okay, now and let's go back to the equity. We have in the, which are detailed in the article. So I think now we have a methodology that's dating from the 60s, for which the people that came up with, so it was Markowitz who received the Nobel Prize in the 90s. For the analysis that was undertaken. So it's, in essence, it's trying to establish a relationship between, again, the risk-free rate and a relation to the volatility to overall the market returns, in the correlation with the firm's own performance that comes or generates a certain cost of capital. Now, again, what we have in that function, we make full abstraction of the externality cost. So what we could do is we could add it as a function, again, of our observations, our readings to the CO2 ppm or to the finite carbon reserve, that we have. So this is the 420 gigatons that we currently have as a reserve, as a carbon reserve. And then we can say, okay, we're going to add, let's say, 4 to 5%. And again, we could undertake more precise research to calibrate the exact level. And then we can actually consider rebates as a result of the rankings in this universe of best performing corporations. For the best performing, you could actually take away the full, carbon margin that would be applied to 4 to 5%. And so for the people that are, heavy, which have a very heavy carbon footprint, you would leave, or they would not be able to abate any of that cost. So what you would do as a result of this calibration methodology or change in that methodology is that you would leave a higher cost of capital for those companies that don't, undertake any incentive to reduce their carbon footprint. And as a result, you would increase the hurdle rate or the discount rate. So it's, in a way, it's the proposed methodology is a way to decarbonize, the discount rate that is applied, in fairness opinions at the moment. It's in M&A transactions, in private equity transactions. So we all use this these fairness opinions based on a discount rate, of which, it's emanating from the capital asset pricing methodology. but we are not taking into account that carbon footprint. So this is a solution, straightforward, easy to apprehend, or to comprehend and to calculate. So and that's one way whereby you would starting to recognize and reconsider the allocation of your capital as a function of people's carbon footprint and our observations of CO2 ppm in the atmosphere, as well as the remaining carbon CO2 reserve set at about 420
Yeah.
gigatons.
So sort of top-down regulatory requirements regarding disclosures. The methodology is very clear, Frank. If you add a premium to your discount rate that reflects the carbon cost, things will be better. But what incentive will be there? I can see, if I run a company, I can say all my projects will have to have, when I do a net present value, the discount rate is my cost of capital plus something, and that plus something I can tell you how to compute it based on the carbon footprint that project has, right? I can implement that as a CEO in a company. But when you think about the economy, the issue is, unless there is a fiat of some sort to say you have to do it, every company has an incentive not to do it, right? And so I don't know what the mechanism would be for us to get there.
Well, I think there's twofold. One is, you come back. It's not the company CEO. I think the burden actually lies with the institutional investors, because they also have a fiduciary duty, right? So if right now what we're doing is, as we said, we're agnostic of this carbon footprint. So we are using a much lower discount rate, and as such, we're ballooning the valuation of a company, as it actually might be in the future. So with the potential onset of, and I said potential, climate calamities on these corporations, you have actually ill represented your shareholders, your investors, in that regard, by underestimating the carbon cost into your discount rate. So that's first. That's the fiduciary duty, and I think which each institutional investor should take care of. Secondly, I come back on the central bank and the Fed, and ultimately, I think there we have right now, we've seen with this quantitative easing. So again, for people, I want to make that use very. So it's this digital virtual line of credit provided by Treasury to the Fed, and allowing the Fed to use this digital line of credit to inject money as part of the stimulus packages. And so we have done this for 2008. Now we've done this again to the tune of 3 trillion for the COVID-19, right? So imagine now that we are having major climate calamities that occur, right? And as such, that the Fed has to intervene in order to make whole states or individuals, because of the insurance companies are no longer in a position to pay out the compensation for the insurance holders, because they have an insufficient capital base. So now it's on the burden of the central bank to fall back on this mechanism of quantitative easing to create that stimulus to pay for the people that suffered from the climate calamities. But that's a common good, right? So we all have a stake into the value of the underlying currency. The more we're going to debase, the more we're going to fall back on the quantitative easing policies, the more we debase our currency, the more I think we end up, or we potentially end up, with a depreciated currency, potentially creating inflation if we go back to the 1930s in the Weimar Republic in Germany. So that's a potential link that we have to, and as such, there's an interest from a central bank, both from a monetary policy perspective, but more importantly from a supervisory perspective, to make sure that adequate discount rates are applied into the assessment of corporates, and especially when you do lend money, in the case of banks, because that's we have to be very careful here. So it's the Fed, the central bank, is actually the supervisory authority are the banks, the supervisory authority is the Fed, which are supervising the commercial banks. And in the case of the institutional investors, it's more the SEC. So you would have an element whereby the Fed, in conjunction or collaborating with the SEC, would actually impose this kind of change in valuation.
Yeah, I like that idea, Frank. So let me see if I understand this. So at time equal to zero, the market is not going to price in the cost of environmental degradation, right, into securities, debt and equity included. But because Fed is increasingly a major player in the market, whether it's quantitative easing, open market operations, discount window, interest rate setting, what you're suggesting is that as a major player in the market, Fed could impose something on the market in such a way that the market prices will ultimately, not at time equal to zero, but at a future time, will reflect that cost?
Correct. I think, what we see with the Fed is now the market maker, the sole market maker in town for treasuries, mortgage-backed securities, and already for a very large extent, for corporate bonds. That's already a given. So especially when we come to the corporate bonds, they could apply that methodology. So when they purchase the asset from an institutional holder, they could set a discount rate that takes into account that carbon footprint. They have
but it has to be almost security by security, though, right?
Well, I think in a sense that you could set the in the case of the in the case of the fixed income, I think you could also apply a discount rate that would reflect the best in class performance. So I think it would be individual by individual, but that's how you price an instrument. I think it's not overall it's not you're not doing it by sector. I think you do it by individual corporation or by individual issuer. And again, we do have the disclosure material. We also will have shortly Trace, which of which Carbon Tracker is one of the prominent kind of players. 24/7 online kind of tracing capability of greenhouse gas releases on a global scale and at the level of a fishing boat, right? So I think this is a great kind of gauge or a great kind of element to measure at the individual level of corporation or company that's issuing greenhouse gas that's releasing these greenhouse gases. And as such, you could, price it for non-compliant companies or people that have a heavy carbon footprint. You could price, that into your into every individual pricing of your instrument.
So some people have preferred, this won't be a market mechanism in the sense that it is disclosure, it is disclosure specific discounting. It will be more mechanistic, So what has happened to the carbon tax idea?
Yeah. So what we have seen in the I think we have a Nobel Prize in 2018 that was awarded for the introduction of the carbon tax, but we still we haven't seen anything in any tangible measure that has been introduced. We had at the beginning of this year, I think it was more than 4,000 economists asking for the introduction of such carbon tax. So nothing has happened, and so it might have to be with, of course, some resistance by some lobbies and by some vested parties that of the introduction of that. The same actually applies for the offset markets. So the offset markets is a part of a market whereby if you have actually saved a release of a certain greenhouse gas, you can go to a market and claim a credit for that. So and that allows a company that has been less or that has been more profligate into the release of its greenhouse gases to buy those credits. And we've actually seen, with the COVID-19 crisis, an enormous drop in the prices of those markets. And there's also, if you look from a global perspective, in terms of volume, 80% is taking place in the Europe or in the Eurozone, and only 20% located with the markets in California and Canada. So this is again, this is very unfortunate that we do have, again, we see these calamities happening as we speak, and yet financial markets fail, completely fail to capture those observations into the functioning of the market and into the pricing of the different instruments, be it the claim in the claims market, or be it in the fixed or the equity market.
Yeah. I mean, you can understand from an incentive perspective why that's the case. But conceptually, everybody sort of agree that we need to do something. But so you have a market-based mechanism out there that people haven't really systematically implemented. It cannot be country by country. I know that some countries have carbon tax, but it is not useful unless the entire system implements it, right? Well, what you're suggesting is that rather than waiting for a market mechanism to kick in worldwide, why don't we take the biggest player in the market, in this case the Fed, and create some level of discipline into the market?
Correct. And again, so there's a quote here I like from Milton Friedman. So only a crisis, actual perceived, will produce real change. So, and when that crisis occurs, the actions that are taken depend on the ideas that are lying around. So this is also a bit of, my idea to share some of those ideas on the platform, on the Forbes platform. But, wanted to come back on, there are elements where, where we have to start thinking. So we can't deny, we can't be proud of our footprint in 2020. So we have this six-headed, as I mentioned at the beginning, we have this six-headed, crisis. So what are some of the ideas that we could embrace? And I think one of the notions is to introduce the notion of what I would call the caring economy, the rewarding economy, the healing economy, because we are in pain, whether it's, our economy as a nation, as individuals, we need healing, we need caring, absolutely. And so, so there are some notions in there, I think, that we, could incorporate in a sense, so that, given our stresses that we can see in our daily lives, but especially in the realm of climate change. So there is an element whereby a central bank, and in this case the Fed, could issue rewards, right? In rewards, in a sense that you could be provided with an incentive to start, regenerating part of your economy. So let's take an example. So now you have a private initiative it's a company, it's a startup company, it's called Regenerative Network, so Regen Network. And, they are providing an incentive to farmers who are, working the topsoil of their land. And so the topsoil, by working the topsoil of the land and by moving away from synthetic fertilizers, which are contributing to the overall heating up of our earth, they are giving an incentive to enlarge, to magnify the sequestration or the carbon sink potential of the farmer's land. So that's an enormous benefit, for us as a society, but also for the Fed in future years, it could prevent having to intervene, as I had referred to, through quantitative easing, having to print money in order to pay out people suffering from climate caused calamities. So you could give right now all kinds of incentives to make sure that these efforts are being initiated. The same for working on wetlands restoration. It could add to flood defenses, as we've seen last year with the Mississippi flooding. We had a major disruption in the supply chain. Right, these are things as a human race we see, as a civilization we see, we can. So there's a solution out there. if we actually, again, start to think outside the box and start to be creative about what those challenges are and how we actually provide the right incentive for people to reallocate resource and capital to those beneficial kind of activities.
I want to quickly touch on, Frank, one of your other Forbes article, the Fed and digital currencies, what's possible. So what's a digital currency?
Yeah, so a digital currency is actually a currency for which, it's not tangible. So when you do have a coin or a note, that's tangible, it's cash, right? So, but now what we have already with a digital currency is actually the currency that's not actually account-based, or that's not actually, or that actually can be provided by a virtual token. So these are, kind of two kind of essential elements to a digital currency.
So it has a lot of implications, right? If digital currency becomes a standard in the future, it has implications for dollar. It has a lot of ways that macroeconomics could change, right?
I think it has very, very major kind of impacts in the sense that I think I want to come back on the ability for a commercial bank to print money by the extension of credit, right? So now if a central bank is joining that party of credit extension by, using or issuing digital currency, it is actually claiming for a part of the pie that's currently being owned by the commercial bank. So there is this kind of calibration of market share between the commercial banks and the central bank. But I want also to use this as an opportunity for two different things. So I think right now with the decline in the dollar and the rise in the gold prices as we currently are experiencing, I think there's a lot of talk about the reserve currency status of the US dollar. And one of the elements, again, I think there's this short-term and short-term elements to be considered in the long term. So in the short term, I think these risks are maybe over or exaggerated. But in the long term, I think what you could do with a digital currency or a central bank issued digital currency is, speak to the appeal of a population at large. So you could incorporate one of those elements, a solution to climate change and a solution to, for example, financial inclusion. So there's a lot of people that don't have a bank account. So right now you could actually, with this creation of a digital currency, you could actually extend that to a part of the population that are currently not reached. Or that
you can remove the intermediary in some way. Yeah.
Correct. Yeah, I think I think this is the whole thing. This is where I come back on my first point. This is going to be a whole debate being issued is, what's going to be the bank's position, commercial bank's position? Are they going to be, interpositioned or, are they become the intermediary between the central bank and the individuals, or are they completely going to be left out? And are the tech companies, the big tech companies, going to, take their position as a facilitator of these digital accounts into the market? So that's going to have a huge impact, and discussion is going to ensue there because it's important. It's hugely important, for the way we make progress, but also how market share is going to be defined for commercial banks.
Yeah. So when there are winners and losers in a policy change, it's always tough to move anything. But I really like this idea, Frank. It also gives the Fed, as you say, more flexibility and more power. So to the extent that I guess this is a big if, the decision makers at the Fed has an overall view of societal cause and optimum capital deployment, and I would argue that it's a big if, then they could actually implement it because they have a lot of power in this situation.
Correct. And I think, at least, there's many considerations that, thought should be given to. But I want to spend on, again, on the innovation aspect. So as I said, you could, with this digital currency, you could actually provide incentives for people that contribute to the regeneration of our commons, right? So clean water, clean air, clean soil. So these are very important elements that you could use this new type of monetary policy. On the other hand, I think one has to be also mindful of the concentration of power. If all of a sudden now you're going to give a central bank
right.
this ability to issue that digital currency, so what is going to be extremely important is now you have to exert kind of prudential power or prudential supervision over that activity, and that's where Congress or a appointed institution by Congress has to come in order to defend, because ultimately what counts is the preservation of the intrinsic value of the national currency, right? So whether it's a virtual currency, I think, or a fiat currency, or whether it's become a digital or a central bank issued stable coin or digital coin, I think whatever. But I think ultimately what counts is, for the welfare and the well-being of people is also that's in their interest, that, and actions are taken in their interest. So even including, protection from, the calamities that might arise from climate change.
Yeah. These are big and interesting ideas. Hopefully we can move in one direction. Where do you think the Fed will end up in terms of its balance sheet by the time we are done with COVID?
Well, it's currently standing at 7 trillion. So this is could easily, I see another, I think we could easily see 10 trillion, so another 3 trillion, without major impact. So, and this is something what I think we have seen so far, I think with the COVID-19 crisis, where we stand at the moment, I think the markets have still not fully, in my view, digested or interpreted, the default risk that still has to be translated into the numbers.
I want to ask you about that. So there are two views on that. One is when Fed pumps liquidity into the market, stock markets go up. But I've seen some papers that say it shouldn't really have any effect, neither on the long end of the interest rate nor on the stock market. Where do you come down on that? Is this really a Fed liquidity driven event in the stock market?
Well, I think so, in the sense that the market senses that there is backup for, even to the point where we have where we've seen private equity being backed or bailed out and backed up by a central bank. So I think what you do give the signal in terms of you're coming back to the risk allocation mechanisms or capital allocation mechanism, is that you do give you feel that there is some support being given by a central bank, by the sole market maker, and you're being sustained in that your capital allocation process, right? So there's no signal being given, okay, now we need to change, and that's somewhat perverse kind of. These are perverse outcomes of QE. While QE is absolutely needed in times of crisis, there are some very, very deep perverse outcomes, as a result of QE. And you only have to look at the fact that you have right now, you have a real estate market which is inaccessible for millennials. A millennial, as a result, because you had so much liquidity injected, and it went either into the stock market or it went into real estate. And as an outcome, you have real estate prices which are, as I said, non-accessible for the majority of the millennials. You have also, as a result of the over some buying, and this is mostly, US has not been impacted yet by the negative interest rates, but now you have in large parts of the world, in Japan and in Europe, pensioners with negative interest rates in their portfolios, and they are afraid to spend because they
run out of money.
Discounting. Well, exactly. They're fearful of not having enough money, and as such, you're in a downward spiral of your largest segment that should be consuming and should be spending, that is afraid to do so. So this is also with a digital currency, the introduction of a digital currency, you could consider mechanisms whereby if you are age dependent and you had a certain amount of fixed assets in your portfolio the last 3 years, that a certain minimum floor would be provided in terms of interest rates. So that would be this is what I would call innovative monetary policy. I mean, in the sense that that digital currencies would actually procure and would offer.
Right. Excellent. Yeah, this has been great, Frank. Thanks so much for spending time with me, and good luck with all your work in this area.
Thank you so much. It's been an absolute pleasure. Really, thank you for the opportunity. And also the best of luck with your endeavors. Super endeavor, by the way.
Bye.
Thank you. Bye-bye.